Have you ever looked at a cryptocurrency chart, seen an asset locked in a persistent falling trend with technical sell signals flashing across multiple time frames, and yet heard a group of passionate market participants claiming it is completely undervalued? It makes you wonder if they have spotted a diamond in the rough, or if they are simply trapped in a sinking financial ship. Today we are diving deep into a highly unique setup that is causing exactly this kind of intense polarizing debate across the decentralized finance and derivative trading community. We are looking at Tower Semiconductor Limited derivatives trading under the ticker symbol TSEM, currently holding a distinct position on global tokenized asset indexes at rank number 7,939. This derivative asset has recently stepped into the bright spotlight of the market. Over the last 24 hours, the price has experienced a tight fractional consolidation move, ticking upward by 0.67% to rest at a premium price of exactly $247.93. This minor positive movement follows a much larger macro correction, leaving the trading community completely divided down the middle. Is this slow horizontal stabilization a clear sign that massive institutional accumulation is happening before an explosive breakout rally? Or is it a sophisticated value trap designed to lure in retail capital before another leg down? Before we break down the underlying mechanics, the liquidity depth, and the momentum indicators of this high value derivative contract, make sure you hit the like button right now, subscribe to the channel, and it is absolutely compulsory that you leave a comment down below telling me if you are currently holding TSEM or if you wouldn't touch it with a 10-foot pole. Your interactions are what keep this channel alive, so do not wait, leave that comment right now. To truly understand why the Tower Semiconductor Derivative token is causing such a massive stir right now, we have to look closely at what this asset actually represents and why it has suddenly stepped into focus. Unlike standard layer 1 coins or purely speculative meme tokens, TSEM in this ecosystem operates as a tokenized derivative asset. It is engineered to mirror and track the valuation metrics of Tower Semiconductor Limited, a major global foundry that specializes in manufacturing analog-intensive mixed-signal semiconductors for sectors like automotive, consumer electronics, and industrial automation. By bringing this asset class into the decentralized finance and synthetic asset trading space, market participants can gain exposure to real-world industrial equity price movements directly on the blockchain. It is in sharp focus today because of a massive structural friction point between the performance of the traditional semiconductor industry and the chaotic sentiment of the decentralized derivative markets. In times of global supply chain rebalancing or shifting technological demands, semiconductor-linked assets experience heavy institutional rebalancing. When that institutional volatility bleeds into a tokenized derivative market with lower liquidity thickness, the resulting price action becomes an absolute battleground for day traders, swing traders, and automated arbitrage scripts looking to profit off the resulting spreads in premium pricing. When we transition over to the technical analysis, the charts paint an incredibly tense and complex picture for the TSM derivative. The primary macro trend direction has been dominated by a clear, persistent downward slope over the recent cycles, characterized by a steady sequence of lower peaks and declining valley floors that show persistent overhead supply. This consistent lack of upward momentum has triggered multiple automated technical sell signals, as short-term moving averages have crossed cleanly beneath the longer-term historical baselines, confirming that institutional and algorithmic sellers have been dictates the pace of the order books. However, as the price stubbornly stabilizes around this $247.93 mark, the asset is testing a massive psychological and historical support zone. This mid-$200 level is a massive line in the sand for the remaining buyers, representing a zone where historical buying interest previously stepped in to absorb heavy sell orders, creating a temporary floor for the market. If this support floor holds over the coming days, it could lay down the necessary foundation for a powerful relief rally, or at least a prolonged period of horizontal accumulation. On the flip side, the overhead resistance levels are incredibly dense. Any sudden push upward by the bulls will immediately run into a wall of selling pressure from trapped traders who bought in at higher levels and are just waiting for a minor bounce to exit their positions at break-even. Momentum oscillators like the relative strength index are hovering in deep oversold territory, which is exactly why some market participants are screaming that the derivative is fundamentally undervalued. But veteran traders know that in the world of tokenized derivatives, an asset can stay oversold far longer than retail accounts can stay solvent, and short-term weakness remains the dominant narrative until a massive spike in trading volume confirms a structural trend reversal. When you look at the broader ratings and market signals available for the TSM derivative, the automated data streams and liquidity health scores lean heavily toward an attitude of extreme caution. In this specific niche of the decentralized asset market, you do not have traditional Wall Street investment banks giving formal buy, sell, or hold ratings on the token itself. but you do have decentralized smart contract scanners, whale tracking tools, and historical consensus algorithms analyzing the derivative contract's health. Right now, these independent technical ratings are pointing firmly toward a sell or strong sell bias because of the total breakdown of key historical market structures on the daily and weekly charts. The negative signals are compounding as blockchain ledger data reveals that large wallet holders and liquidity providers are slowly but surely reducing their exposure or shifting their capital in less volatile base assets, leaving the remaining retail base to absorb the daily fluctuations. The short-term outlook for TSEM remains highly defensive because the asset lacks a strong independent marketing or product catalyst within the crypto ecosystem to break it away from general market conditions. When major base crypto assets experience sudden liquidations, specialized derivative markets tend to suffer from a sudden drying up of market maker bids. The flashing red lights on the technical scanners are a clear warning to day traders that stepping into this chart right now carries a high probability of loss, yet the highly speculative crowd continues to ignore these negative signals, betting everything on the hope that a surprise earnings beat or an unexpected technological announcement in the legacy market will completely rewrite the token's technical reality overnight. This brings us to the ultimate question that is tearing community forums and trading groups apart. Is the TSM derivative genuinely undervalued at these current prices, or is it a textbook value trap designed to lure in naive buyers? The argument for it being deeply undervalued rests heavily on the fundamental strength of the underlying semiconductor manufacturing sector. Proponents argue that because real-world chip production is essential for artificial intelligence, automated vehicles, and modern infrastructure, a tokenized asset representing this value must eventually recover its premium pricing. They view the current $247 price point as an incredible discount, arguing that the token is simply resting at an absolute cyclical bottom before the next major technology cycle triggers a wave of organic institutional buying. However, the counter-argument for this being a dangerous value trap is incredibly compelling. A value trap occurs when an asset looks remarkably cheap simply because its price has experienced a massive crash, but the market fails to realize that the fundamental demand for that specific derivative wrapper is completely evaporating. If traders lose interest in trading legacy assets on the blockchain, a low token price doesn't make it a bargain. It just makes it a stagnant, depreciating asset that is slowly bleeding liquidity. Retail traders frequently look at a high nominal price tag and assume it must represent institutional safety, completely overlooking the fact that a synthetic or derivative token can always drop another 90% from any price level if liquidity is entirely withdrawn from the decentralized pools. The downside risk associated with TSM derivatives are massive, and the underlying volatility is precisely why retail traders so frequently find themselves completely trapped in these types of setups. In the decentralized derivative space, lower ranked tokens suffer from incredibly thin liquidity depth in their automated market maker pools compared to their traditional finance counterparts. This means that a single large sell order from a major fund or an early liquidity provider can trigger a catastrophic double-digit price crash in a matter of minutes, completely bypassing any stop-loss orders that retail traders have set on their decentralized applications. Retail buyers often enter these highly volatile derivative positions using excessive leverage or investing capital that they desperately need for daily expenses, driven entirely by the intense fear of missing out on a massive recovery. Once the chart begins to slip, psychological panic takes over, but because the selling pressure is so concentrated, the bid-ask spread widens exponentially, making a clean exit virtually impossible without accepting devastating financial losses. This creates an emotional and psychological trap where retail investors decide to convert their short-term momentum trade into an involuntary permanent long-term investment, holding on for dear life while hoping for a miraculous recovery that may never come as automated trading algorithms slowly grind the remaining asset value down to zero. If we map out the absolute best case bull scenario for the TCM derivative, it depends entirely on a massive resurgence of community coordination and a sudden, unexpected influx of external liquidity. In this optimistic recovery timeline, the current support flow holds perfectly over an extended period, causing the immediate selling pressure from early holders to dry up completely. A major whale or a coordinated group of decentralized autonomous organization buyers steps in, executing massive market buy orders that trigger an aggressive short squeeze, forcing day traders to buy back their short positions at a loss. The sudden surge would cause TSEM to break cleanly through its immediate overhead resistance levels, transforming the previous technical sell signals into a flashing momentum buy indicator as the trend reverses lines on the daily charts. If the project behind the derivative protocol delivers a major upgrade or manages to secure a high-tier centralized exchange listing, the token could easily erase its recent structural losses and begin a steady march back toward its previous historical highs. Conversely, the bear case is an incredibly straightforward continuation of the downward spiral. If the psychological support floor snaps under the weight of ongoing liquidations, there is very little historical order block data available to prevent an absolute free fall. The downside momentum would accelerate rapidly as the remaining retail holders panic and cut their losses, causing trading volume to dry up entirely and rendering the token completely stagnant, leaving it to sit permanently at the bottom of the tracking matrix as another warning sign of market brutality. Looking at the overall market outlook, there is a massive, unbridgeable divide between the short-term reality and the long-term potential of the TSEM derivative. In the short term, the price action is going to be completely dominated by market noise, order flow imbalances, and highly speculative day-to-day manipulation. The price is highly likely to remain incredibly erratic and choppy, providing dangerous trading conditions that heavily favor automated high-frequency scalping bots rather than casual human investors. Long term, the absolute survival of the token depends entirely on actual protocol adoption and whether the platform hosting these derivatives can construct a sustainable economic loop that outlasts the current speculative market wave. The harsh truth is that the vast majority of experimental synthetic tokens launched in this sector have an incredibly short operational shelf life, completely fading into obscurity within a couple of years once the initial marketing capital runs out or regulatory framework shift. For TSEM to break out of that destructive cycle and achieve multi-year viability, it must transition away from being a purely speculative digital trading instrument and transform into an undeniable piece of financial infrastructure that traders are willing to use on a daily basis. Ultimately, we are left standing at a critical crossroads of complete market uncertainty, staring at a chart that could just as easily double your risk, capital, or completely wipe out your allocation by tomorrow morning. The technical data tells us to be incredibly cautious, the passionate online community tells us to buy the dip, and the economic truth usually lies somewhere precariously hidden in the middle. Is the current $247 price tag of the TSEM derivative a final warning sign to stay away, or is it the absolute quiet before a massive storm of profit? Let me leave you with one final cliffhanger question to think about. If you woke up tomorrow morning and saw that the TSM token had dropped another 50% from this exact level, would you look at it as a tragic investment mistake or the absolute buying opportunity of a lifetime? Think about it, leave your honest answer in the comment section below. Make sure you have liked the video and subscribed to the channel, and I will see you in the very next market update.